Can you all hear me? Hello. Can you all hear me? Good morning to you all. Please start on topic income receivable. Please start on topic income receivable. Please start on topic income receivable. Income receivable are amount receivable for the account period, but not yet received in cash. Received in cash. But not yet received in cash. The double entry is debit income receivable debit income receivable and credit relevant income account. Credit relevant income account. Okay, Ayami, can you read the, Mehansa, can you read the examples here?
The accounting period of Pyramis business ends on 31st December. Rent income of rupees 12,000 has been received and rent income of rupees 3,000 is yet to be received. A fixed deposit of rupees 120,000 at an interest of 10% has been opened on 1st April, and the interest income has been accrued for the month of December.
Okay. So the first part, rent income 12,000 has been received and rent income of 3,000 yet to be received. So you receive in cash 12,000 and 3,000 further, extra amount further need to be received. So that 3,000 has not been received in cash. So you need to account for that. So how you account for that? Debit rent income receivable and rent income credit. Income receivable debit like a debtor debit, sales credit. So same way here, income receivable debit, rent income credit. And the second one, you're supposed to receive interest income for the month of December, which has not been received yet. So that you need to calculate the December interest, 120,000, 10%, that divided by 12, that gives you 1,000. So interest receivable debit, interest income credit. Is everyone okay with that?
Yes.
So in terms of accounts, what you do is, so you have rent income, uh, cash, you received 12,000, that is need to be credited, and income receivable 3,000 need to be credited. Rent income receivable has a debit balance 3,000, and interest income, cash, you receive 8,000, and interest income is 1,000. Interest income receivable is debit 1,000. With regard to the financial statements, you always record the full amount of revenue for the period, that is profit and loss statements. Rent income 15,000, that is 12 plus 3. Interest income is 9,000, that is 8 plus 1. And current assets, accrued rent income 3,000, accrued interest income 1,000. Okay. I'll give you 10 minutes, so please do try this one. Activity 2, please try everyone. Okay, just copy the structure. By the way, yesterday's commerce paper is really easy one. So it gives some sort of a easy paper for your seniors. So you know what is going to be your paper. Please do prepare. I feel some students are not take that much serious. So it's high time you need to focus the subjects. Okay, so you don't have much time, especially this time the science paper is really hard, and as well as the maths paper, there are some kind of a argument that the time is not adequate. So you need to prepare for all this stuff. Some problem. Okay. We'll ask Nihara, can you read the first one? Can you read the first one, Mihara?
Sir, I don't have the textbook right now.
Sorry, it's okay. We'll ask Tarini. Can you read the first one? Uh, Visandi, can you read the first one? Minuti, can you read the activity 2, please?
A shop has been rented for 6,000 rupees per month from 1st of January 2020. Rent income relevant to only 8 months has been received in cash.
Okay. So just write rent. How much you received in cash? So 6,000 into 8, that is 48,000. And how many more months to go? 4 months to go. So 4 into 6, 24,000. So what is the total income is addition of 48 plus 24. Sorry, 48 plus 24. Or 6,000 multiplied by 12. Second one, Minuti.
Money of the business has been deposited to open a fixed deposit of 50,000 rupees. Interest income of 4,000 rupees has been received, while 2,000 rupees is to be received relevant to this fixed deposit.
Write it down interest income. Iyaksali hambela tinada 4,000 received. And how much to be received? 2,000. So altogether your income is 6,000. Okay, next one.
Only 6,000 rupees has been received out of the 8,000 rupees of dividend income receivable.
Okay, so write it down dividend income. So altogether 8,000 is your income, and making hambela tiyenne 6,000. So remainder is 2,000. Fourth,
Sales commission income of 4,000 rupees is to be received as a result of selling goods owned by another enterprise.
sales commission. So 4,000 to be received. That's the amount. So we'll put the double entry, rent income receivable. Rent income credit. Dividend income receivable. Dividend income. Sales commission, sorry, interest income. Interest income. Sales commission. Income receivable. Sales commission. Pass the double increase. Rent income debit. Receivable debit and rent income credit. Interest income receivable debit, interest income credit. Amount is 2,000. Accounting for accrued rent income. And then accounting for accrued interest income. Sales commission income. Sales commission. 4,000. Accounting for accrued sales commission income. This is sales commission. Right. That clear? Now we draw the profit and loss. Statement of financial profit. Current assets. Current assets. So write it down. All the income, you take the full year, full amount. And then accrued one, you take whatever highlighted here. Amount which need to be collected, which is not received in cash. Everyone. Everyone clear on that? If you have a doubt, please ask. Income receivable is an asset account, and income is revenue or income account, so that need to be credit. Asset account debit. So asset debit, revenue credit. Okay. But we move on to bad debts. So please write our topic bad debts. Okay, this is the debt. This is the debt which cannot be recovered. This is the debt which cannot be recovered with 100% certainty. With 100% certainty. Sandinsa, what's the double entry for credit sales? What's the double entry for credit sales? Tarini? Double entry for credit sales. Double entry for credit sales. Vinuti?
Debtors account debited, sales account credited.
debit debtors and credit sales. There are others. We just did it, the income receivable. We already did in grade 10 this one, credit sales double entry. So you sell goods on credit basis. Since you sold goods on credit basis, what will happen? You will not receive money now. Instead, you will receive money later. So debit debtors, credit sales. So now that debtor won't pay you. If that debtor won't pay you, what will happen? It's a loss for you. So that loss is considered as a bad debt. So we'll write it down to double entry for bad debts. Bad debts, credit debtors. Debit bad debts. Right? Vihanga, can you read the example here?
Kitsuru's business has sold goods on credit to Samira for 8,500 on first 8 months. I don't know. As Samira has died in an accident, it is decided to write off the dues from him as at 2021 December 31st. The journal entries and ledger accounts are shown below.
So the double entry debit bad debts 8,500 and credit Samira 8,500. Okay. So bad debts account debit, Samira's account, you have original balance that come from credit sales 8,500 and that need to be credited, so you don't have any closing balance. Okay. Next item topic, depreciation. So depreciation is a allocation of cost of a non-current asset. Over its full life. Depreciation is allocation of cost of non-current assets over its useful life. Okay. Vihanga, can you read the depreciation note?
Yes, sir. In order to present the financial position and the performance in a better manner of a business organization, some assets of the business should be depreciated. These are the assets that are not intended to resell, but used in the operations of the business and have a long-term existence. These assets, such as buildings, machinery, office equipment, and motor vehicles, are called as non-current assets. The amount of asset depletion during its economic useful life or due to asset being outdated is known as depreciation. Factors for depreciation includes economic factors such as being out of date and physical factors such as wear and tear. The total cost of the asset comprises of all the costs incurred for bringing the asset into the present location and usable condition. Such assets can be used for more than 1 year. These assets may be sold to another party at the end of the life of the asset, and the amount obtained is known as scrap value. Accordingly, there is an opportunity to recover a part of the cost of an asset through the scrap value. The scrap value will not represent a significant portion of cost of an asset, and therefore a major portion of an asset cost is not recoverable. This irrevocable cost of the asset should be regarded as an expense over the years that the asset is expected to use. Example, a machine has been obtained for a cost of 500,000 and it is expected to be used for 5 years. If the scrap value of the machine is 100,000, the irrevocable portion of the cost of the asset is 400,000. Since the expected useful life of the machine is 5 years, this 400,000 should be expensed over 5 years as an expense. Therefore, this expense should be distributed between the said 5 years. Accordingly, when an asset has a scrap value, the balance we get by deducting the scrap value from the cost should be distributed between its estimated economic life as expense. According to the example above, 400,000 which we get once the scrap value of 100,000 is deducted from the cost, 500,000 should be distributed within 5 years of economic useful life as an expense. There are a number of factors that contribute in deciding the amount of depreciation per annum as an asset. First, cost of asset. Second, estimated use of life of the asset. Third, scrap value of the asset.
Thank you. So here, let's say you purchase a laptop for rupees 100,000. So that is your purchase price, or we call cost. And assume you can use this laptop for 5 years. Okay, after which, after 5 years time, you could have sell it for 10,000. That's called scrap value. So three component with regard to the depreciation. One is cost of the non-current assets. Remember, this depreciation concept is applied only for non-current assets which have limited useful life. Those are used in the business, but it's for the limited useful life. So you have a laptop you purchased for 100,000, and you can use this laptop for 5 years, assume. And at the end of these 5 years, you can scrap it off, and you will receive 10,000. So that's we call scrap value or residual value. Another name for scrap value, residual value. Now you need to calculate the depreciation. So write it down. Depreciation equal formula cost minus scrap divided by useful life. Cost minus scrap divided by useful life. So 100,000 minus 10,000 divided by 5. That is 90,000 divided by 5 comes is 18,000. That's called depreciation. And then write it down, depreciable value equal cost minus scrap value. That is 100,000 minus 10,000. That is 90,000. You can depreciate when over the period of 5 years. So factors that contribute in deciding the amount of depreciation. So what are the three variables? Cost of the assets, please write it down. right? You write this down. The cost of assets include purchase price of an asset, plus all costs incurred in bringing the assets to its present location and condition. Yeah, cost of the assets. Purchase price. Carriage inwards. Installation. Copy this down. Yeah. So I will stop with that. I'll be sending tomorrow 6 to 7 the additional hour. So join tomorrow around 6 a.m. Okay. So stay safe and see you tomorrow, and you can see physically next week. Okay. Stay safe. Okay.
Thank you, sir.
Thank you.